What's up, everybody? Welcome to another live video.
Yay, I'm back this week.
Woohoo! Yes, I'm sorry.
Although you did a great job.
It's gonna be me, but it's not gonna be me by myself. I know you're all crushed. You're all upset.
You did so good. Maybe you should do it by yourself every week.
Yeah, that's what I was thinking.
What do y'all think?
So good to have us both back again. Let us know tonight where you're watching from. Are you here? Are you local? Are you not? And I want to know if, we're going to talk about taxes tonight. Mm-hmm. And I want to know if you have a story, something bad that happened, something good that happened about selling your home in another state or here in South Carolina. But most people ask us, how much in taxes are they going to have to pay? Mm-hmm. Right? When it comes to the sales price. But that's the first myth, because the tax conversation is usually about gain. It's not about the sales price. And that's kind of the conversation. I think people
automatically think about the sales price as being what they're taxed on. So we'll talk about that because that's not true.
Yeah.
It's kind of confusing.
100%. And I think also some people just aren't numbers oriented. Like I know some of you out there are like, you start talking numbers and we want out. And so I know when we talk about taxes and numbers and interest rates, it's not your jam maybe.
But I think we're going to break it down pretty simple.
Yeah, that's the goal.
Yeah.
Yeah.
Not get too technical on it, but just some considerations.
Yeah. So let's get into it. Let's talk about it a little bit. So where do we want to start?
Well, I think people are scared. I think the biggest thing that I try to do and you try to do when we have meetings with clients and maybe they're accepting an offer on their property, and we try to give them all the tools so that they aren't hit at the closing table with something unexpected, right? But the one thing that we can't provide is we are not CPAs. We're just your real estate agent. So we'll do a seller net sheet that'll say, here's this offer, how much you're going to owe, and basically where you're going to net out at the end of the day. But that doesn't necessarily mean what you pay taxes on either. Like your net after you paid off your mortgage, paid the agent, paid for the buyer's closing cost or whatever you're doing in that offer, that net that you're getting doesn't necessarily mean that's what you're going to be taxed on either. So,
well, and I just want to make a small clarification. Yeah. If you have a great agent, they should have a net sheet.
Yes.
Okay. Not everybody's going to give you a net sheet. They should give you a net sheet. If you don't get one, you should ask for one. Okay.
We do for our clients.
We do it. Surprise.
But again, we're not CPAs.
Yes.
And so what we provide you is different. So you can't take a settlement statement from a real estate closing and say, this is what I owe you. It plays into what you're going to owe, but it's not the whole story. And that's something that you have to have a conversation with your CPA. And we recommend doing that before you sell your home so that you're not blindsided by anything along the way. And so we're going to give you some considerations and things to present to your CPA when you're selling your home, because that's really an important thing. And it's easier when you gather the documents along the way instead of trying to hastily find them at the last minute after you've already sold your house. Yeah. So here, let's talk about your tax bill. So these are things that you should be providing to your CPA. And so one of those is the original purchase price.
They need to know what the price of the home was.
Yeah, because that's what they're going to be basing your gain off of. That's the major chunk. There are other factors that play into it and that can add to that price, so you'll have a little bit less gain. But the first thing is, what did you originally buy it for? So maybe your original closing statement you could provide.
Yeah. And then after that, what you want to figure out is, okay, anything that you did to the property, any major renovations, any major improvements, you want to be able to document that as well.
And we're not talking about like, hey, the toilet clogged and you called the plumber and you fixed it. It's really not a minor thing like that. It would be a major improvement. So you replaced the roof, you added a pool, you changed from carpet to all hardwood flooring. We're talking about like real improvements to the property, not really those day-to-day keeping up, maintaining your property type bills. Although you can still keep those receipts and give them to your CPA. Maybe they'll be able to do something with them. But overall, we're mainly talking about major updates to your home.
Well, when you buy, after you've lived in the home, usually you're there a couple years, you should be doing something to the property to improve it every year, or at least keep it at the level at which it should be at, so that you can not have to do 50 things one day when you sell, unless you just don't care. And then the other thing is, when you do go to sell, you are going to notice some things you need to do to sell it or to get it back caught up. So those are the things we're talking about. Those are the items.
Yeah, and make sure to keep all receipts along the way, because something that maybe you own the home for 15 years and 12 years ago, you did a major renovation on it, and now you don't know where you put the receipt. It's somewhere in your file somewhere. Well, that doesn't help. Without receipts, your CPA can't actually add that to really a deduction from the gain that they're going to claim for you. So that's the major important thing. If you're a buyer right now, talking about it is, let's say you're about to purchase your first home. This is a good reminder for you that anything you do on that property, keep a separate folder in your computer or at your home files for any kind of receipts, because your future self will really thank you for that a lot down the road. So, any kind of closing fees when you purchase the home or when you sell the home can also help to offset that gain. So your real
Closing
estate
costs,
agent commissions, title work, maybe you pay the buyer's closing costs, any kind of those big chunks that you spent to close the property, either as a buyer or seller, can help offset that gain. So that's why you need to provide those settlement statements to your CPA when you purchased the home and when you sold the home, so that they can see exactly what you paid in order to do that, to
Exactly.
sell it or to buy it.
That's right. Also, how long you've been in the home, right? How long
Well,
you've lived there.
definitely. We'll talk about different really what we're talking about now, and this could apply also to a rental property, a second home, but you're not going to have as big of tax benefits for that type of property as if it's your primary residence.
Correct.
So we'll talk about that too, but I think these things are good to gather for any kind of sale, because even if it's an investment property and you made a major update, then you should be depreciating that along the way. But
that was going to be my next point, was any depreciation you've taken.
Yeah.
So any depreciation you've taken, you want to document that. Essentially, keep good records.
Yeah.
Keep good records of anything that has to do with the home. You want to make sure you understand, are you taking any of these things, taking advantage?
Yeah.
And these are available for you. And there's others. There's a lot of others. So
if you again, like the records, if this was an inherited property, maybe, then you would need solid records, like Frank said, on that, because it might be a step up basis from what it was originally purchased at, depending on how that property was handed off to you in probate. So those things will matter to your CPA, because that could really be an advantage or disadvantage depending on how that was handled.
Well, and the step-up basis comes into play more with the state.
Yeah.
Where someone passes away, then the kids are getting the property. That comes into play more. But you're 100% right.
But essentially, when you provide those to your CPA, they're going to say, okay, you purchased the home originally for $300,000. Between all your closing costs, all of your updating costs, that's another $100,000. You have $400,000 all in. You're selling it for $600,000. So the gain that we're going to claim is $200,000. Now that $200,000 is going to be taxed in different ways depending on if it's your primary residence, if it's a second home, or if it's an investment property. So it could be,
and the state you're in.
Yeah, it could be handled very different. So today we're talking about South Carolina specifically.
Obviously.
These are overall concepts.
Yes.
Don't you think you could use anywhere, but we're going to be more specific to South Carolina.
Of course. They can be used anywhere, but then what they take is the biggest difference. So, all right. The third one there.
Let's talk about scenarios.
Real seller scenarios.
Yeah. So let's talk about seniors downsizing. So there was a myth at one point that if you were a senior, you didn't pay any property taxes when you sold. So that
who started that?
Well, that actually used to be the case. It used to be the case, but it's not the case anymore, because it's really just your primary residence tax benefits that you're getting now, regardless of your age. There's no separate.
You get additional tax breaks, but not on the gain.
No. So that's the biggest thing, because a lot of people might think, oh, I've had it for all this time and I gained 700,000, but I'm a senior, so I don't have to pay any taxes on that. And that is a myth. And you just have to understand that tax laws do change over time. And so what might have been the case when you purchase the property might not still be the case. And that's why I think it's always smart to talk to your CPA before you sell a home.
Well, it's for sure. And it's also good. That's why it's so important to talk to a good real estate agent too, because things change, right? Laws change, rules change, processes change. So are you talking to trusted professionals about this process before you get involved, and you know exactly what's going to take place?
Yeah, because again, your CPA, us as your realtors, the main goal is to advise you so that you don't have these hidden things that come up that catch you by surprise. And we try to mitigate that as much as possible. So
yeah,
if you did think that that's not the case anymore, and you would just still be at, typically it's the married couples would be a $500,000,
$250 single. So $250,000 if you're not married, $500,000 if you are married.
And that would be the amount that you can, if it's your primary residence, that you can gain without paying taxes. So if you made $600,000 as a couple, you'd only pay taxes on the $100,000.
Mm-hmm.
So again, don't you see why this is important to keep those receipts and records? Because really, that could save you taxes on $100,000 if you can prove that you've put that into it.
Absolutely.
While you've owned it. But if you don't have the records, you're paying the taxes on it.
Well, I also think it's interesting because this has always been something you need to go over. But I think now more than ever, with the jump we saw from COVID, so many more people, this is important.
Sure, yeah.
I think no one's really paying attention to this, but a lot of people gained wealth, and it's in their home. It's in their primary residence. Yeah. And that money you can save on how much taxes you pay. A lot of people, believe it or not, are going to walk away with more than $500,000.
Yay.
So yeah. So the people that are walking with more than 500, every dime over 500, if you're married, if you can show that you spent money on the home, fixing, updating, reno, whatever, you can take that number down and you pay less in taxes, and you don't have to give up as much money.
Exactly. So I think that's
going to be more of a common scenario.
Exactly. Now. And I think people think, oh, and I think this was another myth, if I sell my home and I use all the money, let's say I made $800,000, and if I use all the money and buy a new home with it, I'm automatically exempted because I'm rolling it into the new house. That's not the case anymore. So that is not the case. And also, you don't have to purchase a new home in order to get that exemption of the $250,000 or $500,000. You could just start renting, and you're not still going to pay taxes on that money.
That's right.
And some people think you do have to buy a new home to have that, but you don't. So those are the two myths. One, that you can just roll more than the amount into a new home and you won't get taxed. That's not true. And then two, that you have to buy a home in order not to get taxed, and that's not true.
And don't forget, like, if you have questions right now while we're doing this about this topic, I'd love to hear. One, if you have questions. Two, if you have a story or a comment about how this applied to you or what this could change for you, and any questions you have about it and where you're at now.
Have you ever been caught off guard with a huge tax bill that you wish you had?
I mean, this is real. This is going to happen to people.
It's happened to us before.
Yeah, but it's going to happen to people now moving forward because of that jump in COVID. It's going to happen.
Yeah, for sure.
Second
homes.
Yeah, second homes. I can't read barely. So, capital gains, recapture. We were just talking about that. So
there's not as many benefits if you have a second home. You're probably not claiming all the depreciation and everything that you would if it was a pure investment property, but some people do. And so if you have actually made those depreciation claims while you owned it, they're going to try to recapture that when you go to sell it with your proceeds.
100%.
And you're also not going to have that $250,000 or $500,000 exclusion. Like any of your gain can be taxed at that point on a second home.
Yes. And I think that's the big distinction. So people just need to be aware. Is it a second home? Is it a primary residence? And be aware of that. That's the
Yeah.
biggest thing.
And let's say that it's
Out
a
of state.
rental property, long-term or short-term rental property instead of a second home, then yes, you probably claimed even more depreciation and then you're going to have that recapture.
Mhm.
But if you talk to your CPA and your agent ahead of time and you do plan to roll that into another property, a 1031 exchange is the avenue to go. And you're not getting rid of the taxes, you're simply deferring them. You're kicking the bucket down the road.
Yeah, but I'm thinking about the depreciation. If you sell too early, you have to pay that back.
That's right.
You can't carry that into the next property. So I'm pretty sure. So if you take depreciation, so there's something called a cost segregation study. So you can buy a property and it's really accelerated depreciation is what it is. So if I buy an investment property and I make a lot of money, then what I want to do is buy a property, and if I can rent it out before the end of the year, then I can take all the depreciation where instead of 27 and a half years, little chunks of depreciation, I can compress it and take it all in just a couple of years.
Yeah, most of it up front.
Yeah, and that helps you in that tax year. So, but you have to hold the property for so many years before you can walk and go to the next one. Yeah. So you might have to pay some of that depreciation back. I think, well, I know you have to. The question is, can you not pay it and take it to the next property? I don't think you can. So that's a CPA question.
Yeah, and again, we're agents, not CPAs.
Yeah, we're not CPAs. So.
But what our role is to guide you in questions that you need to ask to your CPA that you might not be thinking of. And so we're trying to advise you of things you should be considering and asking before you make these big jumps into buying or selling. But yes, the depreciation, I mean, that's just taking it off. Essentially, you're saying, hey, I bought a property at $300,000, but now government, it's worth $200,000 because it's depreciated from all the renters and stuff like that. So when you go to sell, they're going to be like, you said it's only $200,000 now.
Yeah, it's the wear and tear over time on a property.
Yeah, but they're going to get their money back somehow.
They're coming to get you. And if you
you
call me because of this video about questions from your CPA, I'm going to be like, I don't know who you are. Like,
but the biggest thing about a 1031 is that you need to know up front because you cannot touch the money. You need to get a QI.
Well, we should explain a 1031 probably.
I guess we'll do that on a different slide. But we're just talking about scenarios. So essentially, these are. Look, if it's an investment property, you need to really talk to your CPA before you start the process of selling. Out of state sellers, and we've talked about this before.
Yes. And
they get hit at the closing table.
Yes.
So this actually happens at closing, not when you file your taxes.
Yeah. And
there's an out of state resident tax, basically, that they take from you on the gain that you claim. So it's not on the purchase or sales price of the property. Your closing attorney is going to ask you how much gain are you going to claim, and then that 5% will come off of that amount. They're going to take it at closing and give it to the South Carolina government.
How many people do you think actually know that number when we sit down at closing? We try and prep.
I give a disclosure to all of our out-of-state
I'm saying, but how many of them actually know the number?
Yeah, and that's why I have that conversation with our clients, because it's like, okay, what are you going to gain? You need to talk to your CPA because that's coming, because you're not an in-state residence. And that amount that you pay isn't the end all be all. They take it at closing, but once you file your taxes, you can get some or all of that back potentially, or you might owe a little bit. So depending on if you claimed it correctly. So that's not the end all be all. They're just taking it, holding it until you file your taxes at the end of the year, and prove all of those things. So that's something to know if you're an out-of-state buyer. If you're in state in South Carolina, let's say you move from Myrtle Beach to Columbia, you do not pay that. That is not taken from you. Even if you're moving out of town, it doesn't matter. As long as you're moving within the state of South Carolina, that does not apply at your closing. So
yep, accurate.
We don't want our clients to be hit with something at the end that they're not aware of.
Ooh, I like this slide. Common myths that get sellers in trouble.
Yeah.
This ought to be interesting.
This is the fun one.
Oh, this is myth versus reality. I like it. Okay. So myth number one, I sold my house, so I automatically owe tax.
Yeah.
reality. Many primary home sellers owe little or no cap gains tax.
Yeah. And I think you're right about COVID. Everybody's appreciation went up
Yes.
probably more than expected. But if you can again prove that you've put money into it, and
This
then
isn't
the
gonna-
closing costs.
This isn't going to be the case soon. I mean, I think it's record numbers of people that have like a majority of equity in their home. I think it's like 50% of people that own homes have 50 or 60% equity in their home. Like it's some ridiculous number.
Well, equity is different than your gain, though.
Well, that's
so,
true. That's true. That's true. Second myth: my age gives me a special tax exemption. Age alone does not create a special federal income or home sale exemption.
Yeah, so we
Exclusion.
kind of briefly hit on that.
Yeah, we did. Myth number 3: if I buy another house, I can avoid tax automatically.
Wrong. So
Buying another home does not automatically wipe out the tax. Yeah, that doesn't.
Well, things have been certain ways over time, and then they change, and people are like, "No, wait a minute, that's."
Well, but you also have all these people on social media like, do this, do that.
Yeah,
if you do
it
this,
gets confusing.
And I think a lot of times on social, especially, you get a piece, and part of it might be true, but they're not telling you the whole story.
Sure.
So you got to know where, what, all the stuff.
But we did mention this before. They are trying to up the capital gain limits because the 250
Yes.
and 500 have been there for a long time.
A long time.
And inflation has gone way up. So they're saying we need to update this to be the current levels of where it should be.
So you can make more money, keep it, and not
Yeah.
have to pay taxes to keep up with the times.
And so we don't know when that's going to happen. There's talks about doing it, and it makes total sense, but we don't know when or if that will happen. It should.
Yeah. If I live there once, it counts as my primary home forever. Timing and actual use matter.
Yeah.
So
we had a home in Charlotte that we lived in for like 7 years, and we moved here and we sold it in like year 6 or something. So where we had just rented it 5 years. If we had sold it in year 5 after moving here, we would have been fine because we had lived in it for 2 years. So it has to be that you've lived in there for at least 2 out of the last 5 years. It could be you lived there 1 year, rented it, lived there another year, rented it, but it has to be 2 years out of the last 5 years in order to get that primary resident exemption.
yeah. I was just thinking while you were saying that there's a lot of rules that reside around 2 out of the last 5 years.
Yeah.
Kind of weird.
It is weird.
Same thing with the
They
building
like that. I guess they like
license
that.
and a lot of licensing requirements. That's interesting. Okay. Anyway, not tonight's topic. So let's go on to the next slide. Out of state sellers.
Yeah. So here's that withholding
Which is
tax.
kind of what we talked about. This is a little more in depth though. So if you're selling and you live out of state, that may apply to you at your closing table.
I mean, unless you tell the attorney, I'm not making a gain.
You could say that.
But there has been over time where sellers have come to the closing table with money because they actually owe more than it's worth at that point. And it's not funny. It's a terrible situation for somebody to be in. I guess the silver lining is you don't have to pay the taxes at closing.
Yeah.
You have no gain. So again, just keep good records of what you've done to the property so you know what kind of gain you can claim. Because let's say that I was like, oh yeah, I put in a new HVAC 7 years ago. And so you take that off what you're going to claim. But then when you go do your taxes, you don't have a receipt for that. You're probably going to have to pay taxes on that now because you do have to prove you have to have receipts. Just saying you did it isn't enough. You actually have to have documentation of the repair.
You're saying
and
if you don't show something eventually, yes.
Yeah.
Yeah.
So you don't have to show receipts when you originally make that claim. You tell your attorney, I'm only claiming $40,000. You don't have to show the receipts when you make the claim to the attorney. But at the end of the year, your CPA is going to look at your settlement statement and say, okay, this is how much you claimed. And then he's going to say, show me all the receipts and everything from when you've owned the property. And then if that doesn't align at that point, then you might owe more taxes. Now, if you had forgotten about certain things and you can provide receipts, you might get money back from taxes that you had already paid. So it could go both ways, but that's why those receipts are so important.
Agreed.
Because you can say anything at the closing table, but you do have to eventually prove it.
Yeah,
so
for sure. They're not going to let you walk out of there and just give a verbal.
Yeah.
Often handled at closing. Withholding is not always the same as the final tax you owe. And so I think we've covered everything else.
Mm-hmm.
Yeah. Okay. So I think we beat the out-of-state seller situation to death there. All right. 44% capital gains deduction.
So that isn't actually like a deduction off the sales price.
Yeah,
it's kind of confusing.
That's what people are thinking.
I know. That would be great. That seems like a good headline. When you're reading it, you're like, that sounds great. That's amazing.
This state's awesome.
Yeah. Federal tax and South Carolina tax are not the same thing. I think we all know that when we pay 2 checks every year, but it can, I guess if you don't pay a lot of taxes every year, you wouldn't know that. But South Carolina allows a deduction equal to 44% of qualifying net capital gains.
Yes. I just want
to. But you still might have to pay the federal taxes. Mm-hmm. It's just you wouldn't have to pay as much state taxes.
That's right. I think it's important. I've said this before because we've talked about taxes before. But when one headline comes up, we have to address it, but then we have to sometimes cover stuff we've already covered. It is very important for everybody out there to understand that this is one of the primary benefits of real estate. And we're not talking about that tonight, but taxes. So if you're not familiar, most are when they start buying property, they start to understand. There is a lot you can do when it comes to lowering your tax liability through real estate. Mm-hmm. So make sure you have a good CPA that understands real estate deductions and how to, lower your tax liability, because it really matters. This can make a huge difference in your life because it's one of the largest expenses you'll ever pay.
And you hit the nail on the head, Frank, because all CPAs are not created equal. I've said this before.
Like real estate agents.
Yeah. And there are some that do not really know the codes when it comes to real estate investments and real estate write-offs. So your CPA might not might not know certain things that you can do to offset your tax basis because they just don't know. Not that they're, not good at what they do, I suppose, but they're not good at the investment part of it and guidance.
Yeah. And so what I would say is reach out. We have experience with this actually quite a bit.
Yes.
Of picking the type of accountant that we want to work with.
Right.
If you have questions about how to pick the right accountant, we're not experts on it, but we're pretty good at it. Mm-hmm. If you have questions, reach out. We'll be glad to help you find help you understand how to find the right accountant by asking certain questions and what to look for. You can reach out to us at the contact below, the 704-910-9111. You can text, or you can call, or you can go to carolinacraftedhomes.com or email either one of us at frank@carolinacraftedhomes.com and tiffany@carolinacraftedhomes.com. And we can help you understand and refer you to resources that will help you. It's that big of a deal. But absolutely, it's a big deal.
It might cost a little more upfront for a good CPA that understands tax laws in regards to real estate, but it will save you in the long run. Trust us, because we've been burned before, but we've also had really good experiences too. So we can share all of that. But when you do get burned, it teaches you a lot. But I think Frank's biggest pet peeve is having to call and give recommendations to the CPA instead of the other way around. So
yeah, if you find yourself, and this really goes with anything, if something new happens, like there's a new bill that's being passed, we're not going to talk about tonight, I don't think, but we're going to talk about
but maybe next week.
Yeah, maybe next week. We have an exciting new bill that passed here in South Carolina, and so we want to talk about that. If one of my clients called me today and said, hey, this just passed, and let me know, I'd be excited. I'd be like, cool, I didn't know yet. Okay. But if it's something that's been around for a while, a year, and I didn't know, and I would blame myself. I should know.
Yeah.
So it's the same thing with a CPA. If they don't know about a deduction or whatever, they should understand most things. Now, something new happens, okay, but they should be making sure they're staying up so that they can help you with your taxes.
But again, if they have, what do you call it? Like they're focused on real estate and investment type tax credits, and that's what they're focused on and they're good at, they're going to always be researching those new codes and helping out that type of client. So you just it's important to somebody that specializes in real estate investment properties.
Agreed.
Second home, vacation, or rental. The rules vary.
Yeah, I mean, people think they're all the same.
Yeah.
Really.
Well, some people say, okay, I'm going to get a rental property. And it's different also when you get a loan, because a second home loan and an investment property loan are different. And that's when your loan officer is going to talk to you about that part of it. But today we're talking about taxes. So let's say that you say, oh, I vacation there X number of months a year, or maybe it's half of the year I go there and half I stay at my regular home. The things you can claim on that is not the same as having a true investment property, because they do have a limit on the number of nights and days that you can actually personally use that property to claim it as a true investment. And I think a lot of people don't understand that. So if they're over that amount of time period that they're staying there, they really can't get all the tax benefits of a pure investment property.
And again, this comes down to picking the right real estate agent and understanding the difference, that there is a difference between the three, and being able to have that conversation.
And maybe your goal is just to purely have a second home and maybe not rent it out, or maybe rent it out to help cover some of the cost, and you don't care about all the tax benefits, and that's fine. That's your goals. But if you're sitting here thinking, I'm going to have an Airbnb and I'm going to use it all the time and claim all of these good write-offs, then you might need to talk to your CPA first. And because you don't want to use it throughout the year and then realize at the end of the year when you file your taxes that you actually do not qualify for some of those. Yeah. So anyways, another thing to talk to your CPA about.
100%.
Because those are kind of intermixed, don't you think, when people think of like a second home investment type property?
Yes. And it can get more complicated. When you have, when this kind of stuff starts to happen, it can get more complicated.
Well, that's why we're talking about getting a good CPA that can really dive deep and knows all of the laws and benefits, the tax code as it relates to these things.
Yeah.
Because it is, trust me, it's very complicated for sure. And we've talked about
yes, primary residence exclusion. If you're single, it's up to $250,000, and if you're married filing jointly, it's $500,000.
See, again, I'll say it again. Another reason, benefit of being married.
Oh, that was last on my list.
Oh, okay.
But these are a lot of this though is, I think some people look at this and they go, wow, that's a lot of money. It is a lot of money, but
yeah,
this is just being in the real estate game.
Yeah.
A lot of people made money during COVID just because they bought, not because they were smart, not because they made a great decision. A lot of people just bought just because that's the thing to do. And they just were fortunate to take advantage of the market that we had with COVID. And so it just goes to show, but if you rented during that time,
yeah, oh man,
imagine making $250,000 or $500,000. Either one could have been the opposite, zero, and actually lost money if you rented. So if you rented for 4 or 5 years during COVID and you paid $2,000 a month, let's just go lower and say $1,000.
Okay.
$12,000 a year times 5 is $60,000. So you lose 60 because you get nothing back for renting, or you could make $250,000.
And we don't usually see a market like that where we jump up in value so much, but it happened.
Yes.
And then it's kind of like interest rates. They doubled overnight, and everybody's like, man, if I'd only known, I would have gotten in on that game. But it's the same thing. So that, again, there's never a perfect timing, but it's whenever you're ready to buy a home. But everybody that has that fear of diving into a primary, they might think, I don't have the down payment money. There's a lot of myths that go into if I can buy a home or not. And we can talk about that at another time. But buying a home, they have 0 down programs. They have all of this benefits that you can qualify for, especially they have first time home buyer gifts and things that the state will provide and the Fed will provide. So depending on the loan type. So there's a lot of resources.
This is a classic example of people not wanting to get into something. They're trying to time it right.
Yeah.
Right. So either one, not getting involved in the first place at all, which, there's always levels at which you can get involved. And that's what we do this for. We love to help people get into real estate. But there's also the point of people saying, well, timing the market. Yeah. And there's this old saying that it's not timing the market, it's time in the market. So if you own a home and you always own a home, then you don't have to worry about missing this hot market because eventually it will come.
Yeah.
But if you focus on trying to buy at the right time, you're going to miss it. And that is what we're talking about.
But I think that's the difference between saying I'm ready and homeownership makes sense to me. And then it doesn't matter. I'm not trying to make $1 million in a year. But if that happened and we did it, all of a sudden you find yourself in that market, you're going to be so happy. But a lot of people got so stuck in the fears of what if this, what if that, and kind of got paralyzed and did not step into the housing market. And now they missed out on the low interest rates, the low housing prices that we had for like over a decade time period there. And now that's been gone for a long time now. Mm-hmm. So you're right. And also, I mean, it goes the other way. Sellers that bought in the early 2000s, and then we had the huge market crash and their house was worth half of what it was worth. And then it went back to what it was worth originally during the COVID years. So it's cyclical for sure. And so you're right about the timing of it. But that's definitely a benefit of being there. And some people think, and they might not want to sell a home. Let's say it's your first home and you're thinking about selling it because you want a bigger home or whatnot.
Yeah.
Some people think I'm going to owe so much tax when I sell my property. Mm-hmm. I don't want to do it. But that's really a myth. Just because you sell doesn't necessarily mean you owe taxes, as we've been talking about. Right. And I think that's a major point that we're trying to make today is there's a million different scenarios around the sale of your particular property that you just have to be aware of. What bucket do you fall in? And then what can you provide to your CPA to help you offset any kind of tax liabilities you might have?
100%. Couldn't have said it better. And so I think it's particular to each person. If you have questions about buying in Myrtle Beach or selling or renovating or building, or if you have an oceanfront property, you want to rent, and you need some management, that's what we do. We do all of this. But the most important thing on any of that we do is helping people make great decisions, because whether you want to do business or not now, we don't care. We're just trying to help you get the right information. Yeah. So, and that's what we're about, because we know that will help the industry, it will help you, and maybe one day we will do business together. So
make sure to tune in next week. I think we have a pretty interesting topic.
Yes, very interesting.
Yeah.
It's about time, really, if you want to know the truth. It's kind of insane that it hasn't happened yet.
It's something that's angered me for a long time.
Yes.
And so
I'm still angry because other people are still dealing with this, and it's insanity.
And they're making it like a really cool TV show about that kind of thing now.
Yes, they are.
Anyway, well, those are little teasers, but it is going to be a fun topic next week.
We'll send you a Carolina crafted mug.
Yeah.
If you can tell us what we're talking about next week.
Oh, yeah, there you go.
So we'll send you a Carolina crafted mug if you tell us your name and where you live, and you get the topic right for next week. How about that?
Sounds good to me.
All right. If you have any questions, our contact info is below. We hope this helps you guys navigate a little bit better. That's why we do this. And a lot of these topics are because this is what we are seeing that all of you want, based on searches, based on what people are asking us for. And so that's why we're doing these topics. Next week is one of ours.
Yeah.
All right. All right, everybody. Till next time. Talk to you later.